Welcome back to the Market Insights webinar. Always great to have you with us on Friday afternoons. I'm Danielle Nezel, Product Manager with BMO Exchange Traded Funds. I'm stepping in for Kevin Prince today. You know what? It's Kevin's birthday today, so he's taking the afternoon off. So Kevin, if you're listening, have a happy birthday. We have a great discussion prepared for you today on options. I even learned a little something looking through the deck this morning, so exciting conversation. We're going to learn how they trade on the exchange, how they trade on ETFs, and how you can access options-based strategies using ETFs. Before we get started, we always like to start with our disclaimer. I'm sure a lot of our listeners and viewers are used to seeing the disclaimer by now. Just want to remind you, and I want to highlight, we're not providing advice and we're not providing recommendations. Today's session is just all about market insights and education with a focus on ETFs. And again, we have a few guests outside of BMO today, so I'll just run a couple other disclaimers by you. Same story, not providing advice, not providing recommendations. It's all about having a little fun as we learn about ETFs and the market and what's going on in the economy. We have a great lineup of speakers today. This is really exciting. So Chris McKinney joining us from BMO ETFs. Chris is a portfolio manager and he works a lot on the options-based strategies for BMO ETFs. We have Richard Ho joining us from the TMX. Richard is the head of retail equity options. And Sean Gibbons from InvestorLine. Great to have you all with us and welcome. So Sean, we're going to kick it off with you because you have a great promotional offer that you're going to tell us a little bit about.
Yeah, thanks, Danielle. Actually, we have two great promotional offers, one both on our InvestorLine as well as Advice Direct platforms. The first specifically being for this audience. What we're offering is $4.95 equity and ETF trades for the first 90 days. Very simple. To enroll in this promotion, all you do is use the promotion code InvestSmart when opening a new InvestorLine self-directed account. Second is for our Advice Direct platform. Now, this is a very lucrative offer. We can get up to $2,500 promotional bonus by opening a new Advice Direct account using promotion code Digital07 and funding with at least $50,000 by June 30th. Now, keep in mind, Advice Direct is not an options trading platform, but what we've been finding is a lot of our clients will utilize both Advice Direct and InvestorLine together to enhance their overall research tools, essentially getting a little bit of the best of both worlds, if you will. If we can just proceed over to the next slide. When clients first open their accounts, one of the things that I really like to highlight is our education center. It's often overlooked, but hugely important. Here we have included a variety of resources, like how to use InvestorLine, and as you will see below, there's even also 3+ hours of videos just on options trading, from how to use options in your RSP and TFSA, even over to the most common mistakes that one might want to avoid. So the big takeaway from here is whether you're a seasoned investor or even new to options trading as a whole, there are resources to assist. You just need to know where to find them. That being said, Danielle, I'll throw it back to you for now.
Fabulous. Thank you, Sean. That's a great resource. Speaking of tools and education, Richard, the TMX has something. Do you want to talk us through what the TMX has to offer?
Yeah, that's right, Danielle. And since the topic today is about options, I think this will be for sure of interest to the audience. The Options Education Day is an industry-wide event on options, and this is hosted by the Exchange in collaboration with all the FIs. So the conference will be on May 31st, as you can see, at 12 p.m. Eastern Time. It's going to be a fabulous event with lots of great speakers. Now, just to name a few, we have Tony Zhang from CNBC Options Action. We have Brian Mozoff, who's CEO at Ether Capital, and also market macro guru Patrick Ceresna, and so much more. Best of all, this is a free event, so I strongly recommend everyone to attend. Now, even if you cannot make it on May 31st, I still want you guys to register because we'll be giving one to everyone a free e-handbook of the event So to register, simply jump over to m-x.ca/VOED. So back to you, Danielle.
Thanks, Richard. That looks great. I'll have to circle May 31st in my calendar. So today we're talking about options. Richard, you are the perfect guest because you are an expert in this space. Maybe we can start the discussion and you can talk to us a little bit about the requirements for listing options on the exchange.
Yeah, so options is very particular because all the option trades on the Canadian market, that gets directed over to the Montreal Exchange. Now, let's talk about listing options because we get lots of requests from advisors, from investors asking for options. And for the audience on this call or show, they can also ask for specific options on names that don't have options today. Simply jump over to our website and send us an email. So today, as of today, we have over 40 different ETF options that you can choose from and more than 270 stock options. There's also a currency option on the US dollar. Just like last year, the US dollar lost over 1,400 basis points. So if you have any US stocks or holdings, you can use a currency option to hedge that currency risk. Now, since we're talking about listing options, let's get these straight, okay? The facts. In order to get options listed on a stock or ETF, we have a listing committee. And the listing committee will take a look at the top 30 percentile in terms of two things. The first thing is the daily average trading volume. And the second will be the value of the available public float. But for ETF options, they look at something different, which is the public float. It has to be at least $20 million. Now, once the listing committee comes up with a list of potential new option candidates, what they do next is that they present these names to the market makers. Now, once the market makers accept quoting on these new names, then the exchange will list new options for trading. So this, in a nutshell, is the process of listing new options. Back to you, Danielle.
Thanks for that. Really interesting. Really, that liquidity being such an important consideration when thinking about options. So Chris, I'm going to bring you into the conversation right now. So options, they don't just trade on stocks, they also trade on ETFs. Can you provide us some insights on this?
Sure, and certainly, since this is typically an exchange traded fund webinar, we thought it was important to point out that typically investors think of options being on single stocks, and for example, if I like Apple stock, I'm going to buy a call option on Apple and get some of that upside or what have you. But it's important to note that there are existing options on several ETFs that trade in Canada as well. And this slide here shows just what the largest ETFs are in terms of open interest, in terms of the options that are currently out there and some of the largest trades that we've seen over the last week or two. It's interesting to note that these could actually go much higher because of the liquidity of the underlying ETFs. But I think it's interesting to point out that because you can have an option on an ETF, now you're not just taking, excuse me, you're not just taking a bet on a single security or expressing a view, but you can do it on an entire sector. We see ZEB up there as one of the largest open interest ETFs. And so you can either buy a call or a put or what have you on an entire sector of companies. Similarly, on an entire country, ZSP representing the S&P 500 or XIU representing Canadian equities. And again, sectors like XEG. So you can really mix and match what sort of exposure you want to achieve through your options by using, again, geographic exposures, sector exposures. And here's one other thing, even different asset classes. You see XCB on this list, and there are a few different fixed income ETFs in Canada that have options listed on them. So now you can start taking a view on corporate spreads, for example, or where interest rates are going to move. If we look south of the border, TLT, that's the long-term U.S. Treasury ETF, has a lot of options activity on it. And so one of the most popular ETFs to have options activity on it. And so investors are betting on the move in long-term interest rates through that sort of strategy. So there's a lot of different ways you can use exchange-traded listed options to express a view on different asset classes and different sectors.
Now, Chris, trading options, this is something that you do professionally. So for those at home that are thinking about it, what types of terminology is important to understand that's associated with options trading?
Sure. And first of all, there's the type of option. There's a put option or a call option. And generally, the way to think about that is a call option goes up in value when the underlying goes up in value, and a put option goes up in value when the underlying goes down in value. So that's the difference between the put and the call. And then, of course, I already mentioned the next term, the underlying. So what is that security that the option is on? Is it on a single stock? Is it on an ETF? What's that underlying security? And then you have to move to the maturity or expiry date of the option. And typically those are monthly, but we have seen weekly options being listed now as well, both here in Canada and south of the border. So, make note of not just the month that the option expires, but also the day, because it could be a different Friday. And then the next term is the strike price. So what is the strike price at which that option is valued? And that refers to the price of the underlying stock or whatever the option is on. And then the premium for that option is what that option is worth. Whether you're buying it or selling it, that's kind of the market value of the option. And then the other thing we want to talk about is the moneyness of the option. And this is the relationship between the strike price of the option and then where the underlying security is actually trading. So on this chart, at the top, we have an option with a strike price of 50, just as an example. If the underlying stock is also currently trading at $50, that's called an at-the-money option because the underlying is trading exactly where that strike price is. If the underlying stock was only trading at, say, $48, then the strike price is considered out of the money because it's above where the stock is currently trading. And if the stock was trading at, say, $52, the strike price being below that, then the call option is in the money. There's some intrinsic value to it, and then there's also time value to it, which we'll get into after. But those are sort of the key terminologies to remember. The moneyness, in the money, out of the money, or at the money, and then the other points that I mentioned earlier as well. So just the things to keep in mind when we're talking about options and all the different details around it.
Wonderful. Thanks for clarifying those for us. Now, Richard, I'm going to throw it back your way. Could you tell our investors at home kind of what are the pros and cons of using options?
Yeah, sure thing, Danielle. When we talk about trading options, there's lots of benefits. For example, such as predefined risk, because it's always a good thing to know what your maximum risk is before clicking on the trade button. Second, there is also the use of leverage and capital efficiency. This especially is useful for smaller size accounts. Most likely, higher price stocks would be out of their investment budget. So options could be the solution, providing exposure in these mega cap stocks. Another, very popular option strategy is generating additional income, because it's like collecting rent money on properties that you own. But instead of doing this on a property, you do this on a stock that you're holding inside your account. Last but not least, there's also, investors never know when the market might leg up or down. So if investors have any near-term concerns, they can use options to mitigate stock risks. So these are the benefits of using options. Now, let's talk about the cons, okay? So, any type of investment, you have your pros and cons. Options is the same thing. So when we talk about the disadvantages of options or drawbacks, the first thing you have to know is that if you want to trade options, you have to put in the time and commitment to learn the concepts and terminologies that Chris mentioned about earlier. The other downside of option is time decay, because time decay is one of the more important factors that option buyers face because the option will lose time value as the option approaches its expiration. But the flip side is that you can be the option seller, like that you can benefit from time decay, you see? Now, the other thing, for example, is that when you trade options, you can also short the option. But if you short an option, you will be faced with unlimited risk. And again, if you're not comfortable with the idea of unlimited risk, there are also other option strategies that are covered. So like that, your risk is limited, see? And the other thing is that I find personally, and this is the biggest and maybe most important pitfall for beginners who are trading options is trading too big or using the wrong option without proper knowledge. So at the end of the day, in my opinion, I think that once you take the time and commit to learn about options, it's gonna change how you invest. So Danielle, let's move on to the other slide, which I might, address, about liquidity, because liquidity is also another comment that I get asked a lot or get raised by investors. Because lots of investors, when they talk about liquidity, the first thing that they're going to talk about is open interest or look at volume to determine if there's liquidity. But personally, I prefer to look at the bid-ask spread because the bid is how much you will get if you sell at market, and the ask is how much you'll need to pay if you want to buy at market, okay? So these bid-ask prices, where do they come from? They come from market makers or they come from orders resting on the book. Now, when we talk about the market makers, they have an algo to compute the theoretical price for each and every option line. And what they do next is that they take the theoretical price and they mark up a spread in the bid ask. Okay, so the bid ask that you see is what I like to call the sticker price. Just like how you walk into a car dealership, you see the retail price, but you don't necessarily walk out paying for retail price, asking price. So in order to get the best possible price, I strongly recommend everyone to use limit orders starting from the mid and work up your price up or down, okay, depending if you're buying or selling the option. Because at the end of the day, if your average trade size is 10 contracts, every penny that you save will be $10 in your pocket. So that's how we address or how we get optimal liquidity when you trade options. So let's move on to the next slide and talk about the different types of accounts. Because if investors are interested in trading options, the first thing you need to do is speak with your online broker or Sean, who is on the call today with us, to set up an options trading account. Now you can trade options in a non-registered account or a registered account, such as a TFSA, RESP, or retirement account. But there's one thing that you need to understand is that the CRA only allows certain option strategies to be done in a registered account. So in a registered account, you can only buy calls and puts, which happens to be a long straddle. And you can also do covered call strategies for income and protective puts for stock insurance. Now, for non-registered accounts, you can do any option strategy that you want. So this is the nuance that you need to know and be aware of if you want to set up an options trading account. Back to you, Danielle.
Thanks, Richard. And I love what you said about all our investors out there, put in the time and the commitment and learn that terminology before looking at trading options and investing in options. That's just a great point to highlight. Chris, what are some things to consider when looking at options?
Yeah, and this is something that I talked about briefly, and then Richard mentioned as well, time decay of an option and how that changes over time. if you look at this chart, the thin black line, it might be kind of hard to see, but there's a thin black line there that gives an illustration of how slowly time decay moves when an option maturity is still far away versus how quickly time decay moves when an option gets a lot closer to its maturity date. And so I think investors just need to understand there's two components to the price of an option. First, there's intrinsic value. So again, if that option is in the money, as we say, there's a certain value that that option has just by being in the money. But then there's this time value component as well, and that reflects the uncertainty around where a stock price will end up by the end of the option contract. And so, of course, the more time there is, the more uncertainty there is. That means the more time value an option has. But all else being equal, as that option starts to move closer to maturity, that time value gets a little bit less and a little bit less. But let's think about, if the option is still a long time away, 200 days away, and then 1 day passes by, there's not really that much less uncertainty. 199 days versus 200 days, it's almost the same thing. So the time value doesn't drop very significantly. But once you start moving really closer to that maturity date and you're 1 month out, 3 weeks out, 2 weeks out, that uncertainty really starts to get compressed. And so that time value really starts to decay for you. And so this is something to keep in mind when you're either buying or selling an option. If you're buying an option, generally it's a little bit better to buy that longer dated option so that you're not losing that huge amount of time decay each and every day. Of course, when you're selling an option, then it becomes the opposite. The shorter term you can get, the better, because that time decay really drops rapidly and works in your favor if you're short that option. So just something to keep in mind, again, whether you're buying an option or selling an option, the amount of time you want to the maturity of that option might depend on your ability to take on that time decay and how quickly that might drop as we get closer to maturity. So it's just something to think about. Again, selling an option, you might want to keep it shorter term. Buying an option, you might want to make it longer term. If we go to the next slide, just a couple other things to look at. And this slide, I think, indicates some of our thoughts around the covered call strategy in particular. But certainly can be applied to any option strategy. First of all, the volatility of the portfolio or of the name that you're writing an option on. When we're doing a covered call strategy, we typically try to avoid those very volatile names. Certainly you can get higher premium by selling an option on a high volatility stock, but there's a reason why there's a higher premium. That stock can really move around quite a bit, and quite often you can end up in the money by a significant amount. And of course, that's not good when you're selling the option. So that's just something that we tend to stay away from when we are selling options in this covered call strategy. But again, depending on what your strategy is, just keep in mind that the underlying volatility is going to affect the price of that option as well. And then option selection. What's the moneyness of the option you want? Do you want to be at the money? Do you want to be out of the money? And again, it depends on what your strategy is. And for us, when we're doing that covered call approach, we do like to tend to be out of the money with the options that we're selling. That gives us a little less premium. We're not collecting as much. But if you're doing a covered call, that means you own the underlying stock as well. So you want some room for that stock to go up in value. Presumably that's why you own the stock, is because you think it's going to go up over time. So using out of the money options allows you to, yes, collect a little less premium, but gives you a little bit more room for market growth with the underlying stock. Excuse me. And then the last consideration, again, on covered calls more specifically, is how much of a position do you want to cover with your options? If you own 200 shares of a stock, do you want to write 2 options to cover that full amount? And of course, you're going to generate more premium by selling 2 options, but then you're capping that entire portfolio or that entire position. Do you want to only sell 1 option and only cover half the portfolio? That gives you a little less premium because, again, you're only selling 1 versus 2 options. But that leaves part of your position completely uncovered. So again, if you are potentially looking at using a volatile stock, you want to keep some of that growth potential unlimited or uncovered. You might want to write options on a little bit less than 100% of your portfolio. So a few different things to keep in mind, both on the covered call approach specifically, but also just in general, no matter what your option strategy is.
Great, thanks Chris for walking us through those important considerations. Sean, I'm going to send it back your way. Can you please tell us about some tools available to trade options?
Absolutely, Danielle. Now, that's a very big question. We're going to keep it very brief and just take a brief look at a couple of the tools available to the everyday investor. More specifically, if we take a look at this screen here, what we've got is a BMO call option. And what we've actually done is we've gone a step further. We've started by researching BMO. We've then selected the options tab on the far right of the screen. And then we've actually further filtered it right down just to show the call options as of a specific expiration date. And what you'll notice once we get through those couple of filters very quickly, everything that Chris and Richard just went through in terms of all the terminology and the needed info we need, it's very user friendly. It's all right there, from the strike price to the various bid and ask spreads, as well as the lots, all displayed on one screen. Now, by simply just clicking on the symbol, what's going to happen is it's going to advance me to my order entry, where I can just put in my trade and process that as it goes forward. So Danielle, if we just take a quick step forward, and we'll take a look at one more tool. What we have here is more for our active trader. This is somebody who does a minimum of 15 trades a quarter or has available investment assets of about 250,000. Now, what would happen here is you would automatically, on those two qualifications, you would automatically qualify for this professional level tool called Market Pro. Now, this is provided to you at actually no extra cost, which is great. Very, very unique within the industry. Now, the note with this is it's fully customizable dashboard. It's providing access to real-time data and streaming charts, and you even get access to a little bit more advanced options chain strategies if you choose. Now, what we've done here, just to keep it basic for today, is we've created a little watch list here in the top left. You've got the option chain below, and then a real-time charting just to the right. Now, this is all interactive, so as you toggle through, everything is going to update accordingly in real time. Again, the key takeaway that I really like to emphasize is this is fully customizable. So it's up to you as the investor to determine what it is you physically need for your own research tools, and you can customize it within. Danielle?
Thank you for that. Now, Chris, for some investors at home, maybe listening or watching and thinking, I don't know if I personally want to trade an option strategy, but I liked those benefits that Richard spoke to earlier in the presentation. How can investors get access to an option-based strategy using an ETF?
Sure, there's actually a great number of ETFs that offer a covered call strategy in particular. There are a few ETFs that offer different option strategies as well, but what we've seen is that by far the most popular with investors is the covered call approach. And really, it does come down to the fact that even some investment professionals that utilize options on a day-to-day basis understand that not only is there a lot to learn and understand when you're making that trade, as we've talked about throughout this presentation, but also monitoring that trade on an ongoing basis, just to make sure it's doing exactly what you want it to do. And so there's a lot of time and effort potentially put into trading options and then managing those positions as well once they've been traded. And so a lot of investors really like to buy that strategy and just buy it within an ETF so that it can be left up to the professionals that are looking at it on a day-to-day basis. You can simply buy that ETF and hold it and then let it go and know that on a day-to-day basis, you have an investment professional looking at these portfolios for you, monitoring these portfolios, selecting the options for the covered call process as well. And so professional management, also largely because it's an institutional level type of investment, the pricing that you would get within an ETF for those options generally is better than what a retail investor could get from themselves as well. Better liquidity, et cetera, et cetera. And at the same time as well, the commissions that we would pay by managing one of our ETFs is probably a little bit lower than what a retail investor would pay as well. So, there are several different benefits, and we have seen a lot of investors willing to simply pay the management fee of the ETF in order to get those all those benefits of an option strategy and just have that done, managed professionally for them. If you go to the next slide, this is really a summary of all the different providers that do offer covered call ETFs and the variety of them. And again, a few different flavors as to how the underlying portfolio is built, and then also how that option overlay is run. You know, again, we're thinking about portion of the portfolio covered by options, the moneyness of the options, all those things we talked about do tend to vary from provider to provider. So, you know, certainly take a look at how the different providers approach the covered call strategy and think about the pros and cons of each and which one might be best for you. And then lastly, on the last slide, something to think about in terms of how these strategies might perform in different markets. And, you know, the rule of thumb is that when markets are going down, you're going to collect a premium. And so those stocks you're holding are going to go down with the market. You will go down with the market, but you're going to have a little bit extra buffer because you sold those options and you generated a little bit of cash flow from that as well. In upwards markets, because of that trade-off, again, depending on how far out of the money those options are when you write them, you could potentially trade away a little bit of that upside growth potential in order to generate that regular premium from selling the option. So you could lag the market on the upside. And then in the sideways market, potentially you could outperform as well, again, because you're collecting that premium. But really it does depend on how volatile and how sideways that market is. So that it could go either way there. But again, it's something that a lot of investors have really flocked to. There's a lot of assets in covered call ETFs and in ETFs with option overlays more broadly as well.
Great, thanks, Chris. Now, before we get to our question, Sean, do you want to remind everyone about that great promotional offer you spoke about at the beginning of the presentation?
Absolutely, yes. And lastly, too, for anybody out there interested in taking and implementing these market insights or exploring things further, whether it's just looking at some of the tools through our InvestorLine or Advice Direct platforms, again, my contact information is here. Please feel free to reach out to me and we can set a one-on-one. But just as we were saying, just as a final reminder there, opening any new InvestorLine accounts, don't forget to use that promotion code InvestSmart. Qualify yourself for the $4.95 trades for the first 90 days. And for those stepping away and doing more of an Advice Direct account, that promotion code Digital07 for up to that lucrative $2,500 promotional bonus. Again, I'll throw it back to you, Danielle. Look forward to speaking to a few of you in the future.
Great, thanks, Sean. We got some good questions around options for today. So we have an investor out there. He owns ZPW. That's the put right ETF, BMO's put right ETF. He wants to know what happens if there's a market crash and the puts get exercised. Chris, this is a portfolio you monitor. Can you speak to this?
Yeah, certainly. And so with ZPW, we are selling put options to generate that premium. That's the primary goal of the strategy. You know, if the market sells off and those puts get exercised, we will hold the stock for a period of time in hopes that there could be a little bit of a rebound. You know, typically when stocks go down significantly, they tend to get oversold and bounce back a little bit. And so, you know, there will be a short period of time where we would potentially hold on to that stock and potentially recoup it back up to whatever the strike price was we bought it at. And then we would exit the position shortly after. The goal really is, again, to just kind of recoup any significant loss there might be there in anticipation of a bounce back. And then to get rid of that stock, because primarily this is an income-oriented strategy, so we don't want too much equity exposure in there.
Thanks for clarifying that for us. Our next question, someone holds ZPay, that's the BMO Premium Yield ETF, so that uses puts and calls within it. They'd like to know if the distribution automatically reinvests into the fund or if it just pays out directly into the account. Sean, can you answer this for us, please?
Yeah, absolutely. Very, very common question. We get it all the time on this and other securities. By default, all income and distributions will pay out to the investor. However, the investor does actually have the option to reinvest. One of the fortunate advantages we have with InvestorLine as opposed to some of our competitors is the ability to roll all eligible securities with just a single request. So ultimately, the choice is yours.
Thank you. We have a question about if at expiry date on a put or call option, if it's in the money, is it automatically exercised? Richard, can you speak to this one?
Sure thing, Danielle. So on expiration, at 4 p.m. Eastern time, what they do is that they take a look at all the options out there, and the ones that are in the money by 1 penny will be automatically exercised. Now, this is what we call the automatic exercise feature, and this automatic feature applies to both calls and puts. However, if you are the option buyer, okay, meaning the investor holding this option, you can call your broker and tell them to override this automatic exercise feature, okay, and simply let the option expire worthless. The question may be, why would investors override an option to be exercised if it's in the money by 1 penny? Why would they let that forego, you know? So this really comes down to what the investor's objective and situation is. Because if you have an option, a call option, let's say the strike price is $50 and you have 10 of them, if they are in the money by 1 penny, and if you take a look at your trading account, you don't have the sufficient funds to purchase the underlying stock at $50, then that would be a good example why the investor would let the option expire worthless by overriding the feature. So long answer short is that yeah, any option that is in the money by 1 penny will be automatically exercised. Thank you.
Perfect, thank you. We're running a bit over time, so what we're going to do is we're going to push the questions that we didn't have time for till next week, so tune in for those. Keep those questions coming, we love getting them. I want to thank our guests today, Richard and Chris and Sean, for tackling those questions and for all your insights on options. And just a reminder, this session is provided for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. And particular investments and trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance. Thank you so much for tuning in. We'll see you next Friday, same time, same place.